Good morning, and this is the International Arbitrage, where we talk about the benefits of international structuring for international owner managed businesses, family businesses that are closely held. And today we're going to talk a little bit more about um, self insurance or owning your own captive insurance company. So in this case, we're going to give an example of a non-U.S. person that has, say, an oil field in a country in Latin America, um, and you're trying to raise $40 million from U.S. investors. See other videos as to why that is, you know, very difficult to do or not possible to do in Latin America, raising small amounts of money like this. And so, when you set up your own captive insurance company, what this does is it mitigates a lot of risk in the eyes of US investors. And so, therefore, when you have a captive insurance section in your offer memorandum, it really changes the view of your potential investors and their advisors because they can see that having a captive insurance company does a number of things. It mitigates a number of risks that are particular to small international alternative investments or private equity investments that are run by owner managers. One, a captive insurance company is receiving premiums all the time and can have a dividend payment policy that is different to the that is different to the to the dividend policy of the main investment. A captive insurance company can reduce the risk of the operational risk of the project because, as we explained, captive insurance companies bring vast amounts of savings because having your own insurance company means that you don't have to pay you know all of the overheads, the marketing costs, the employee costs, the building costs, and all the other massive overheads that large commercial carriers have. Captive insurance companies, your captive insurance company won't have those overheads. It will just have administrative and management costs, which are basically less than a percentage point. They're minimal compared to the hundreds of millions of dollars of large commercial carriers. So your ability first to save on insurance premiums vastly increases, and then your insurance policy that written by a captive insurance company that you own is able to ensure the right risks that apply that are relevant to your company. Often with large commercial carriers, businesses, if you have an oil and gas field and you go to a commercial carrier, well, you have to basically take the policy that they issue you, and you may be paying insurance for risks that are not really high, really very likely, or that are not risks in your operation. Secondly, captive insurance companies reduce the the cost of capital. They reduce the cost of capital because you're accumulating insurance premiums. Those insurance premiums are being reinvested, and also captive insurance companies are actually quite tax efficient. So the tax efficiency is another thing that is attractive to U.S. investors. Now, what you can do, depending on how you structure it, is if you're raising funds from U.S. investors, you could give certain or some of your largest investors some shares in the captive insurance company. That way, they are receiving, as part of the deal of investing in your fund, which is investing in your mining operation or your oil and gas field. And that's kind of like a side deal, which of course has to be structured properly with your lawyers. But you can do that, and therefore the captive insurance company now is receiving insurance premiums all the time, and there is a lot less risk as investors could begin to see dividends immediately in the first year, and your business is not being disadvantaged because it's paying insurance premiums which are tax deductible in the jurisdiction where you are operating. And so that's one way, actually, even also of getting profits out of the international jurisdiction. If the insurance premium or the insurance policy does cover a wide range of risks, because sometimes it might be better for investors. You might need to give investors more confidence, so therefore you insure a wide range of risks, and then have larger insurance premiums which are paid every month to your captive insurance company, and they're tax deductible in your jurisdiction. Many jurisdictions that don't allow transfers out of the country, or place restrictions on transfers out of the country. Many jurisdictions are relatively very flexible when it comes to payment of insurance, because many governments and policymakers realize that insurance premiums, people need to reinsure projects and reinsure risk in Lloyd's of London or internationally, or with global reinsurers which are based in the Caribbean. And most politicians and governments understand this. They understand, at a higher level, the way the global insurance markets work. And so therefore, their regulations and laws tend to allow for reinsurance and insurance payments. So these are some of the reasons why captive insurance is a good idea for business, for families that own international businesses. This is definitely something that you guys would want to consider if you're doing an oil and gas project or a mining project in particular. I mentioned these two types of businesses because, to be frank, though, I'm mainly doing a lot of that at the moment, and I can see the improvement in the offer memorandum and in the offering to to investors, especially to U.S. investors who are conservative when it comes to international non-U.S. investments. Captive insurance company can go a long way to reducing the perception of risk and increasing the likelihood of funds being raised and the project being executed. So yeah, that's it for captive insurance in this video. Cheers.